Hello, this video is a brief introduction to external credit ratings where I just have 2 pages to show you. The first page here is a review of the probably familiar to you credit rating scale. I've added some of my own color to this, but more importantly in bullets here, I've teased out what I think are the essential need-to-know items about the external credit ratings. So this is what I think you really want to know or need to know, especially if you're sitting for an exam like the FRM or the CFA. And then on the second page, I'll show you how we treat these ratings numerically, how we perform computations. But we're going to be very careful to distinguish between the ratings themselves that are not numerical and the mapping to the numbers with which we can perform calculations. So here, in terms of the rating scale, you can see I have only 2 columns. That's because the 2 most recognizable credit rating agencies are Standard & Poor's and Moody's. And we go far back enough in time, there's always reference to the big 3. The big 3 would be S&P, Moody's, and Fitch. And in truth, those are still the most prominent rating agency firms. However, there is a designation, a bucket here of firms that are called nationally recognized statistical rating organizations. That's a handful, NRSRO. And at the last count, there are 10 of those firms that fit this designation that are in this bucket. How do I know that? Very simple. I just before this video went to the sec.gov. That's the Securities and Exchange Commission's website. They have a department. It's because they're the ones who decide whether firms satisfy this designation. And the number of agencies within this bucket has expanded over time, so it's fully 10 now, although still S&P, Moody's, and Fitch are still the big agencies. And this designation is not without controversy. It's significant because this designation tells other firms what ratings they can use for regulatory purposes. So it's quite significant from a competitive standpoint for an agency to be qualified as an NRSRO. So if we look at the rating scale here, starting at the top, you can see there is a correspondence here between an S&P AA and a Moody's AA. And I'll call it a correspondence because the methodologies aren't going to be exactly the same, and the descriptors for what these ratings signify aren't going to be exactly the same, but we do tend to treat them as roughly correspondent. You can see starting at the top, we have the highly vaunted AAA rating. You might think that's easy to get, but according to my count, at the moment, there are only 2 U.S. publicly traded companies that have the AAA rating, Microsoft and Johnson & Johnson. So it's a very high rating. And then we go down to AA, and you'll notice that in my graph here, my plot, I've got what I'll call modifiers. One of the firms does call these modifiers. So we can have a AA, but it could be a plus. It could be without any modifier. It could be a minus. So this is a modifier indication of relative rank within the band, right? So we would go from AA negative down to, that could be a downgrade from AA negative, a downgrade to single A positive, or just single A or single A negative. And then we have triple B here. And now for each of these bands, these agencies do make full descriptions as to what the bands signify. And after all, they are the result of extensive research to determine these ratings and then ongoing monitoring and adjustment. And that research is fundamental, quantitative, and qualitative. However, I will just say that we can approximately say these are high quality at AA, then upper medium, then lower medium. And I think, from my opinion, if we look at those descriptors, one of the key things that distinguishes the gradations as we move down is whether or not this issuer or bond is susceptible to change in economic conditions. After all, most bond issues are somewhat sensitive to macroeconomic conditions. So one of the things that starts to distinguish these ratings as we move down is that up here at investment grade, the agency may say that it's very probable or likely that this bond or issuer can make repayment, but they may be vulnerable to adverse economic conditions or a change in economic conditions. So that's what starts to separate here the wheat from the chaff as we move down. This view that, okay, a triple B, we would expect repayment, but the key issue really is, what if there's an adverse change in macroeconomic conditions, a recession? What happens in a recession? Well, then a triple B, that's a key feature of triple B. The agencies just determined that the triple B is more vulnerable in a downturn. Now you'll notice I've drawn a line here because, especially from a study or exam perspective and from a realistic perspective, we want to think about the line here that separates the triple B from the double B. You can see I've labeled over here on the left. This is the line that separates investment grade from speculative, right? So triple B is the lowest rating that is still investment grade. That's very significant. That's not just an incidental boundary, because it has regulatory implication, right? The lower ratings can have a higher penalty in terms of things like risk-weighted adjustment. But very significantly, they're institutional investors who by mandate can only hold investment grade. So think pension funds, for example. So an institutional investor may hold a triple B bond because it's investment grade and it's part of their allocation and satisfied. But if that bond gets downgraded to double B, it may just be a one rating downgrade from one perspective, but they drop out of investment grade, becoming, I think that could be called a fallen angel. And then they become speculative, and then immediately then there are institutional investors who by mandate will need to sell that bond. So it's very significant that an investment grade stays investment grade, and whether or not it maintains that rating. So then we get down to the speculative, hence my coloring start to change, and the rating becomes very high risk, down to D and sometimes even C, where the issue is actually in default. Speculative has synonyms, right? Speculative is also called high yield. Why is that? Well, if you have a lower rating, greater credit risk, we expect that yield to be higher on that bond. And these are also called junk. So junk is synonymous with speculative. So in terms of the items that I just wanted to highlight, especially for exam purposes, I've mentioned this designation, which is very significant to these companies. And the CFA says something you might ask, why do ratings matter at all? And I think this is very interesting. The CFA, I'm going to just quote something that's in the current CFA syllabus. In the public and quasi-public bond markets, issuers won't offer and investors won't buy bonds that do not carry ratings from Moody's, S&P, or Fitch. This practice applies for all types of bonds, governments or sovereign, government-related, supranational, corporate, non-sovereign government, and mortgage and asset-backed debt. How did the rating agencies attain such a dominant position in the credit markets? So in case you missed that, the CFA is saying that basically almost nobody serious will even issue a bond without it getting rating. That's very interesting position of dominance, especially when you consider, when you listen to bond investors, they almost never will admit to using these ratings to make investment decisions. Just listening to Steve Eisman, manager of, I think, in excess of $300 billion in assets on CNBC, within the last 48 hours, and the interviewer asked him, do you use these ratings to make decisions? And his answer was never. And actually, that's a pretty common response. So there's this irony between the fact that bond investors, almost to a T, say that their ratings are not useful to them in making decisions, yet CFA, on the other hand, is saying that that a serious company issuing bonds would never go without using them. Okay, so my second bullet here is the distinction between corporate family rating and corporate credit rating. You can see CFR and CCR. That's just the difference between the issuer and the issue, because we can have a rating for the company, that's Microsoft, but then Microsoft, there's a one-to-many relationship, will issue several different types of debt and bonds, loans, bonds. So even the bonds, we could have senior bonds, we could have subordinate bonds, secured, unsecured. So while the issuer may have a family rating, then the individual credits that may have the issues may have their own ratings, and they might not necessarily all be the same as the issuer ratings. Third bullet is very significant, if only because this is a popular exam type question I've noticed. You'll notice here, ratings are forward-looking opinions. I've highlighted this keyword opinion because I've seen this in an exam question more than once. This is the agencies themselves being very careful to say that their ratings are merely opinions, and there's some legal reason for that. They are not investment recommendations. Fourth point I've already alluded to. If we think about a data scale here, one way to think about a data scale is at the top of the totem's pole, so to speak, is numerical data. And numerical data can be ratio, that'd be the highest order, so to speak, and then it can be interval. And now these ratings are not numerical. That means they're not even interval. If they were interval data would mean, for example, that the difference between a single A and a triple B would be approximately the same as the difference between a double A and an A. That's not the case. These ratings do not even have interval significance. They are not interval data. They're less than that. They are categorical, and then categorical can be, one way to cut that is ordinal and just nominal. So nominal is just categories. Ordinal is ranked categories. And so that's what these are. These are, strictly speaking, ordinal because a single A is ranked above a triple B. A double A is ranked above an A, or put another way, higher credit quality, lower probability of default. However, there is no interval relationship between these. They are just ordinal category. My next bullet here is just want to be mindful of the regulatory and institutional mandate. Again, ironic in the face of the fact that investors don't seem to be huge fans of these ratings, the fact that they have great significance from a regulatory and institutional perspective. Most significantly, perhaps, if we look at the Basel regulations for banking, this is the global guidelines for banking promulgated into country-by-country jurisdictions. Under the standardized approach, ratings are used to determine the risk weight of the bank's assets. So, put another way, ratings are baked into the Basel regulations, just again elevating their significance from a regulatory standpoint. And again, as mentioned before, as part of institutional mandates, oftentimes the institutional mandates do make explicit reference to the ratings, most commonly by saying that we need to hold a certain allocation or entire allocation of investment grade bonds. You can think about it, especially if that's a pension fund with a future obligation to pay workers. You can understand why they would have that mandate. Next, through the cycle versus point in time. Well, if we think about what is the significance of this rating in the context of economic cycles, right? First of all, credits tend to be economically sensitive. During growth or expansion, there should be a lower probability of default, and during recession, there should be a greater probability of default and also greater loss given default. There's the question of, are we trying to measure these ratings at a point in time? And in fact, structural measures of credit risk are point in time, but they are consequently more volatile. These external rating agencies as a general rule, tend to be through the cycle. Or we could say they try to be unconditional. They're trying to speak unconditionally through the cycle and have significance to some extent, regardless of exactly where we are in the cycle at the point in time. Then there are some other qualifiers associated with these ratings. So I've already illustrated here what are called the modifiers or relative value, but also we have outlook. So in addition to the rating, the agencies can also say that we have a certain outlook that may be positive, neutral, or negative with respect to that issue, which might mean it's under review, or it might mean that they're looking at it for a possible downgrade, but they haven't done that, or a possible upgrade, but they haven't done that. So there can be an outlook associated with it. And then notching here has a significant meaning in the sense that, recall, we distinguish between CFR, the issuer, that would be the company like Microsoft, yet that single issuer may have several different bonds. And if we think again in a totem pole kind of fashion, we could have senior, then below that junior, we might have secured junior, unsecured junior, maybe at the bottom here. So in terms of a loss given default, that is to say, if the bond defaults, do we have a recovery? We would expect the junior obligations to have greater loss given default or lower recovery. So if we think about classic credit risk, our expected loss is exposure at default multiplied by probability of default multiplied by loss given default. So for example, the exposure may be $1,000 with probability of default of 1%. Times loss given default. And so let's say that it's a more senior obligation such that maybe the loss given default is 40%, right? In which case the expected loss here might be $4. But as we move down the totem pole to the junior, maybe there's a 60% loss given default such that the expected loss is $6. Right, 1,000 times 1% is 10, multiplied by 40% is 4, or by a higher loss given default is 6. So the probability of default here could be the same, but as we move down the totem pole to junior obligations, the loss given default could increase. And so you can see how, if to the extent where these ratings are trying to incorporate expected loss as opposed to just probability of default, that the junior obligation here would have a higher expected loss and might deserve to have a lower rating. But in this case, the ratings tend to be about probability of default, but the notching then would account for this. So again, a senior obligation here might have a certain rating according to the 40% loss given default assumption, but then a junior issue from the same issuer might be notched down to account for the greater loss given default, even as the probability of default was the same. So that's the notching. You can see here I've labeled it subordinate, CCRs, that's a subordinate issuer rating due to higher loss given default. And then finally, I just have the controversy and criticism. So that's just a reminder that not everyone is a huge fan of the rating agencies and their ratings, especially in the global financial crisis, 2007, 2008. So even before then, there's always been this persistent criticism about the conflict of interest. The conflict of interest refers to the fact that who pays for these ratings? It's the issuers, it's not the investors. And right, so more notoriously is the rating shopping. Some of the research that I've seen about this unintended consequences of expansion of this set of NRSROs refers to the fact that there's now more agencies that can be rating shopped. So that's when an issuer knows it wants to issue a bond, get it rating. That would be the idea that they can actually shop it or take it to the agency who's implicitly going to offer them the highest rating. After all, it's the issuer who's going to pay for the rating. So that's the classic conflict of interest. I've been hearing about it ever since I started teaching the FRM, even before the global financial crisis. Still to this day, I'm not sure that we can say there's much that's been done about that and its role in the global financial crisis. This controversy includes, by the way, the fact that these these ratings so often seem to be lagging indicators, not forward-looking indicators. So that's the rating scale. And then in terms of their mapping to numerical, remember we were careful to say that the ratings are ordinal, which is to say they are ranked categories, but they are not numerical, which is to say they are neither interval nor ratio. However, of course, these bonds being rated, we can then subsequently observe their behavior. Are they then upgraded or downgraded as we observe them? And how often do they default? And the agencies themselves monitor the performance of their own ratings as you would expect. And so that allows us to compute empirical probabilities about the performance of these ratings. And in general, the ordinal ranking does hold up. What that's to say that in general, for most samples, right, a double A does default less than a single A and so on. But what we have is the transition matrix, and it's also called the migration matrix, that's laid out like this. And my numbers are credible. They roughly match recent historical samples. And one way to look at a way to look at this is starting over here on the left in this column is typical would be a 1-year horizon. And this matrix is telling us here if a bond, for example, starts the beginning of the year, beginning of the period as a double A, then we would look across, right? I'll just draw that. We start here. Then we look across the row and we see what could be called empirical probabilities because this is what's been observed in whatever sample we've observed, right? So we always want to be, when looking at a transition matrix, I think it's important to look at the fine print and see what's the sample and what's the historical time period, right? This is usually going to be a 1-year horizon, could be longer, but even if it's a 1-year horizon, usually it's based on a historical window that's longer than that. We want to know that. It's a sample, therefore, the numbers here are going to vary based on the sample. That's sampling variation, we would expect that. But for the given sample, a double A here begins the period, begins the year as a double A, and then what we have here is an empirical probability distribution in this row. For that sample, 1% of those AA bonds upgraded to AAA, 92.5% of them maintained their rating. This shouldn't be too surprising, especially if it's just a typical 1-year horizon. We expect 90% or more, the rating will not change. And then in this case, 6.5% of the AA downgraded to single A. And for this sample, there was no bond did actually worse, right? So then we go down the scale here. Triple B, why is that significant? Why might I draw a mental line there? Again, that's the lowest investment grade. And you'll notice here for this sample, none of the investment grades within that year defaulted. This column here is the default column. That's obviously significant. Then we get into the speculative ratings, aka junk or high yield, and then we do start to see defaults, although even the default numbers still tend to be low. And so what I've colored here is the diagonal, and that is where we are going to expect the big numbers. Right, 90% or higher will not surprise us in a 1-year horizon. This matrix could extend over a longer horizon. We could extend the 1 year to a 2, 3, or 5-year horizon, in which case we'd start to see dispersion, right? A flattening in the diagonal and an increase of the default probabilities. And if we make an IID assumption, that is to say, treat these probabilities as Markovian, Converting a 1 to a 5 is actually very easy. We just multiply the matrix by itself, but then they will disperse. But so this is a typical of a 1-year horizon where we would expect high values in the diagonal, which is to say most of the ratings will be maintained. And then the other key point I would just like to share with you about this transition matrix is, again, what I've already said, and that is that each row is itself an empirical probability distribution. This is meaningful from a calculation standpoint. And what I mean by that is that if we take this row here, this could really become a bar chart or a histogram, because if done accurately, this is a probability distribution, meaning we have here a double A bond at the beginning of the period, and then by the end of the period, what is the outcome? In probabilistic terms, the outcome is going to be one of these mutually exclusive but cumulatively exhaustive events, where each of these outcomes has a probability between 0 and 100. They are exclusive of each other, and that means if properly crafted, in order to be a probability distribution, we need this to be the sum of 100. So when I write questions or debug questions or audit questions, right? That's one of the things I look for in the transition matrix. I need the rows to sum to 100, because if the row doesn't sum to 100, I haven't met that definition of a probability. A key feature of the definition of probability is that the sum of these outcomes needs to be 100%. So that's the case in mind here. You can be sure that I checked for that, but it's also a way to look at this matrix as, of course, it tells us the probabilities of migrating up, down, or defaulting, but this row itself is an empirical, it meets the definition of an empirical probability distribution. So in the next video then, I'll just show you some calculations that we would typically perform if we are given a transition matrix. And I hope this video is helpful. Thank you.